This is the third and final video in our three-part sequence on looking at financial ratios. In the first video, what we did is took a look at Pepsi's income statement, balance sheet, and statement of cash flows from the guided tutorial handout. And again, those financial statements are available online through Google Docs if you don't have the full handout. And we gathered the necessary data to calculate our ratios. Things from the balance sheet, income statement, statement of cash flows, as well as a few extra items that we would need for some of our ratios. So in the second video, we went through and took a look at the liquidity ratios, things like the current and quick ratio, asset management ratio such as inventory turnover or total asset turnover, and then the debt management ratios, things like total debt to total assets or times interest earned. In this third video, we're going to take a look at profitability ratios as well as market value ratios. Let's go ahead and start with some of our profitability ratios, and we've got several different ratios that we're going to use to take a look at profitability. The first looks at the gross profit margin. And gross profit margin looks at just how much is left over after paying for our cost of goods sold. So we take sales minus cost of goods sold, divide by our sales, and record that as a percentage. So we go to our data set. We need that sales data. Sales is $66.504 billion. Remember, all these values are in billions of dollars for Pepsi, and they come from the 2011 financial statements. So our gross profit margin is equal to 66.504. Now we need to take out the cost of goods sold. Cost of goods sold is $31.593 billion. And divide again by the sales, which was $66.504 billion. So then we get our calculator. Go ahead and punch those values in. 66.504 minus 31.593 divided by 66.504. And that gives us a gross profit margin of 52.49%. And again, typically we don't want to write that down as a decimal. We want to write it down as a percent. So 52.49% is our gross profit margin. Gross profit margins, like all of our profit margins, are going to vary quite a bit from industry to industry. And so in order to make comparisons, is this a good number or is it a bad number? What we really need to do is evaluate it to industry standards. We can compare it to the industry average, compare it to some of the major competitors. Another way to look at it is see what's happened over time. Trend analysis. Has it been declining over the last few years, in which case it's not as good? Or has it been trending up over the last few years, in which case that same number will look a little bit better? As with all our ratios, context is key. We have to think about what the number means and what is the story behind it as much as the actual number itself. Next up, we have our operating profit margin, which pulls out not only our cost of goods sold but also our operating expenses. And so let's go ahead and calculate that. Operating profit margin. We need our operating income. Now sometimes you'll just have earnings before interest and taxes and use that as operating income, but in Pepsi's case they had both an operating income and an earnings before interest and taxes. So if we've got that operating income, let's go ahead and use it. 9.633 was our operating income. And remember, that's in billions. And our sales again were the 66.504 billion. Again, we want to express that value as a percent. So we're going to take 9.633 divided by 66.504, and that gives us 14.48% for our operating profit margin. Now notice that's quite a bit below our gross profit margin. That's going to be the case. Your operating profit margin, because it pulls out more expenses, should always be below the gross profit margin. And again, we need that same context comparing to industry average or looking at trends over time to determine if that 14.48 is a good or bad number. Our next way to describe profit margin is the net profit margin. And this is probably the most commonly cited way to measure profit margin. Sometimes people just refer to it as profit margin and not even bother with the net, just strictly talking about profit margin. But because we have gross and operating profit margins here, wanted to make sure we clarified here we're talking about net profit margin. This is just net income. What's left over after all our expenses, not just our cost of goods sold or our operating expenses, but also pulling out any taxes, interest, all the expenses. What's left over is the bottom line. So our net profit margin, we need net income. And I just realized in my collecting the data, that was one piece of information that I forgot to capture. So let me go back to the income statement for Pepsi. Still got that handy. And the net income was down here, net income applicable to common shares for Pepsi. And remember, these numbers are in thousands, so that is $6.443 billion. So let me go ahead and add that to my gathering the data. Net income for Pepsi, $6.443 billion. So now I can use that to calculate my net profit margin. 6.443 over my sales, and reviews that for our last couple ratios, but just a reminder, sales was $66.504 billion. Go ahead and do that calculation. 6.443 divided by 66.504 gives us a net profit margin of 9.69%. And again, good or bad is all relative. The number itself doesn't tell us a whole lot. We've got to put it in the context, compare it to what Coca-Cola is doing, compare it to what Pepsi has done over the last few years. Ideally, we want to see that trending up and better than the industry average. Now, that's not going to happen all the time, but that's the ideal situation that we'd like to see. Different industries are going to have very different profit margins. Retailers tend to have lower profit margins. Companies like software companies often will have higher profit margins, but that's going to vary a lot based on industry. That's why we really need the context. Then we've got return on assets. All these other margins that we've been calculating profitability ratios have been using sales as the denominator. Now we're going to change it to assets. How well are we doing at using our assets to generate profits or net income? In a way, this is kind of like our asset management ratios, but now instead of using sales in the numerator, we're focusing on our assets. How well are we doing at generating profits or net income from those assets? So our ROA is equal to our net income, which remember was $6.443 billion, divided by our assets. Total assets from the balance sheet, $72.882 billion. Go ahead and do the calculation. 6.443 divided by 72.882. And again, we want to express that as a percent. So Pepsi's return on assets is 8.84%. Now our last profitability ratio is going to be return on equity which looks at how well the company is doing at generating net income based on owner's equity. And we want to be a little bit careful there. Focus is going in and out. Hopefully that'll fix it. We want to be a little bit careful here with return on equity, because this is not necessarily what the equity cost a new shareholder. This is what the equity is based on the accounting statements, kind of a book value measure of owner's equity instead of a market value measure. So return on equity is definitely useful information of how well the company is using the shareholders' assets. But for a new shareholder or even an existing shareholder that's looking at what is the value of my investment right now, this common equity doesn't capture it as well as the current stock price. So let's go ahead and calculate the return on equity. Return on equity is just our net income again at $6.443 billion divided by our common equity, sometimes referred to as shareholders' equity or owner's equity, and that is $20.704 billion. Go ahead and do our calculations. 6.443 divided by 20.4, 1.12%. Now, we want to come back to our return on assets and talk about that relative to our return on equity. Remember, our return on assets was 8.84%. The return on equity is 31.12%, quite a bit of difference. What drives that difference between the return on assets and return on equity? And I just realized it would be ROE there, not ROA. But the return on equity is always going to be greater than or equal to the return on assets. And the reason that is true is because it comes from financial leverage. The greater the amount of debt financing we use, the greater this differential is going to be. And if you remember from our second video when we were talking about Pepsi's total debt to total assets ratio, we mentioned that was quite high. They were using quite a bit of leverage, and that's why we see that huge differential here between Pepsi's return on equity of 31.12% and their return on assets of 8.84%. That's why I said we don't want to think of total debt to total assets as bad. Instead, think of it as a risky level, and as we increase our risk, we increase the potential return from that investment. So Pepsi is using lots of financial leverage to magnify their potential returns to shareholders. That's a riskier strategy, but for a company like Pepsi that's got a very stable, predictable cash flow stream, it's not quite as risky as it would be for some other companies such as auto manufacturers or maybe a pharmaceutical company that's trying to develop some new medication streams, things like that. That covers our profitability ratios. Next thing we want to look at is our market value ratios. Market value ratios are a way to look at it from the investor's perspective. How expensive or how cheap is the stock? What am I earning as far as a dividend yield? Things like that. And the first ratio we're going to look at is the price earnings ratio, or oftentimes just referred to as the PE ratio or PE multiple. And that PE is just the market price divided by the earnings per share. So what is the current stock price divided by the earnings per share? Now you can get the stock price from any number of places: Yahoo Finance, CNBC.com, your broker, WallStreetJournal.com. Tons of places have that. I went ahead and used a historical price for this from the end of 2011, but you'd probably want to use whatever your current financial statements are and a current stock price for this calculation. Our market price is $66.35. And now we need the earnings per share. Now, we're not given the earnings per share in this calculation. Instead, we have the number of shares outstanding and our net income. So we have to calculate the earnings per share. Earnings per share is just net income divided by number of shares. Now, a little side note. Technically, it's a little more complex than that. We want to use the net income available to common shareholders and divide by a weighted average number of shares outstanding. But for the purposes of our class, we're just going to use a simple net income divided by number of shares. So our net income was $6.443 billion. And the number of shares outstanding we had as 1.564 billion. Go ahead and calculate our earnings per share now. 6.443 divided by 1.564, and that gives us an earnings per share of $4.12. So plug that into our PE ratio formula. Stock price divided by earnings per share. Take the stock price of $66.35 divided by our $4.12 earnings per share, and that gives us a PE ratio of 16.10. PE ratio is one of the more commonly cited ratios associated with stocks and stock valuation, but it's a very difficult one to interpret. A lot of people are a little bit too lax with their PE ratio and just say, well, high is expensive, low is cheap. But there's so many things that go into the price earnings ratio. Is this last year's earning or is it next year's forecasted earnings? How fast are earnings growing? Lots of different things are going to affect that, and so we want to be really careful. Interest rates are going to affect that PE ratio. The company's risk level is going to affect that PE ratio. So be very careful when you're interpreting PE as to what a high or expensive PE is or a low or cheap PE is. Next ratio we're going to look at is the market to book ratio. Sometimes people refer to it as the market value book value ratio. And again, this is one that's going to cost us or require us to take a couple intermediate steps. We can go ahead and start with the market price, which, like we saw from our previous example, was $66.35. But now we need the book value. Book value per share is just the owner's equity or common equity divided by the number of shares outstanding. So common equity divided by number of shares outstanding is going to give us our book value. Go ahead and calculate, or go ahead and find our common equity. Common equity was given as $20.704 billion. And the number of shares outstanding, same as it was when we calculated our earnings per share, was 1.564 billion shares outstanding. Go ahead and do that calculation. 20.704 divided by 1.564, and that's going to give us a book value per share of $13.24. That's the accounting value of the company. So from the balance sheet, that's what the accountants are telling us each share of stock is worth. Now that tends to understate the true value of the company. There are several reasons for that. One, accounting does not do a great job of capturing the true value of intangible assets. That's not necessarily a fault of accounting. It's by design. They try to be a little more conservative. Also, accounting is based on historical cost for assets, not necessarily the market value of those assets. So in most cases, book value is going to be less than the financial value or market value of the company. So our market value to book value ratio will often be greater than 1. How much greater is going to depend a lot on characteristics of the company. So let's go ahead and calculate that. 66.35 divided by 13.24 gives us a market value to book value ratio of 5.01. Again, Does that mean the stock is cheap? Does that mean the stock is expensive? It's hard to tell. That market value to book value ratio, all else equal, the higher it is, the more expensive the stock is. The cheaper it is, the more of a value the stock is. Sometimes you hear people refer to value stocks versus growth stocks. Value stocks typically have a low market value to book value ratio. But just like the PE ratio, there's lots of things that are going to affect that. Growth rates, intangible assets, risk of the company. All those things are going to determine what the fair market value to book value should be. So lots of people use this ratio, but you want to be real careful in understanding exactly what the ratio is telling us and why you think that ratio is high or low, instead of just arbitrarily deciding, well, that's higher than the market average, that's high, or that's lower than the market average, that's a cheap stock. Our last ratio we're going to calculate is the dividend yield. And the dividend yield just looks at dividends per share divided by the market price. Typically, there are two ways investors earn rates of return from stocks. One is through dividends and one is capital gains. Capital gains depends on the change in the stock price from when you purchase it to when you sell it. Well, since we don't know what we're going to be able to sell it at, it's hard to know exactly what our capital gains is, but our dividend yield is just based on what is the current value of the stock and the dividends per share. How much are we making for owning the share divided by its current value? So when we calculate the dividend yield, we need to find the stock's dividends. And here we had $2.03 on our dividends per share from Pepsi. And our market price, $66.35. Go ahead and calculate our dividend yield. $2.03 dividend divided by $66.35 stock price gives us a dividend yield of 3.06%. And again, is that good or bad? The answer is it depends. Some companies, typically older companies, more stable cash cow type companies like a Pepsi, are going to be able to pay out higher dividends. They're going to have a little bit higher dividend yields. Typically, faster growing companies that are reinvesting a lot of their money into the company are going to have lower dividend yields. But it's also going to vary depending on management strategy. Some companies prefer to use stock buybacks to return money to investors instead of pay dividends. Lots of different things are going to affect that dividend yield. 3.06 as of the time I'm recording that is reasonably good dividend yield. It's not at the highest end, it's not at the lowest end, it's a little bit above the current market average, and that makes sense for a company like Pepsi. Again, this is not your total rate of return from owning the stock, but just one component. The capital gain or potentially capital loss if the stock price goes down is also going to determine your rate of return. This should give you an overview of some of the ratios out there, how to calculate them, as well as some interpretation of the ratios, how to reuse those ratios. Again, this is not designed to be a complex, overly sophisticated look at financial statement analysis. Ratios are hard to use because there's a lot that goes into it. Context is everything. A lot of times people take a very simplistic view of ratios, think, well, I can calculate some numbers and determine whether or not this is a good company or a bad company from a management or an investment perspective. And it's not that simple. We have to know the story behind the numbers. Ratios provide us a starting point. They don't really give us, this is a good company, this is a bad company. Instead, they say, hey, here's something that needs to be looked at in a little more detail. Does this make sense? And gives us a starting point to begin our analysis.